Welcome to Asset TV's Roundtable on Retirement Income Solutions on Global Solutions, with me, Joanne Bainham. Today I'm joined by Wayne Sorour, Head of Sales and Distribution, Old Mutual International. Okay, offshore investing was very much the trend for the last couple of years, and everyone's rushing to get their money out. Have we seen a change in the last 6 months, given how well local equities are doing?
There are obviously two aspects to it. One, clients or people looking purely at return on investment. Then probably, yes, as we've seen, asset managers, some punting local, some still punting offshore. So maybe there's a bit of uncertainty there. But I think that there are other reasons for people taking money offshore, and those reasons will always be in place. Hence, I think us always still getting a fair share of money going offshore. Political hedging, currency hedging, all these type of things are also reasons why people take money offshore, and I think that'll carry on for some time.
So Wayne, do you think it's a function of Reg 28 that we have so much money locally here still because of the constraints around Reg 28? Or what's your thinking on that?
Well, I think, Reg 28 is an interesting one. I think Reg 28, in my mind, is the wrong way around. So meaning when people are accumulating assets, they're young, they want to invest, they need equity exposure, you limit it to 75%, and of that 75, 30% offshore. And when you retire and you take your living annuity, you can put 100% offshore. And I think that's where the income thing comes in as well. But to start with, I think it's the wrong way around. I think when people are accumulating assets and you're young and you're going into a pension fund and ARA, you should be able to go aggressively into equities and offshore if that was the place to be. So if you look at the last 5 years, offshore equities have outperformed local. And if local do come into vogue in the next couple of years, well, then you can, your asset manager or person managing your money can make those adjustments. But I think the limitations of Reg 28 obviously affect that, and that's where the big money lies. So it shows they still want to have exchange controls in place, because pension money is where the big money is. I mean, individual money that we deal with is very small as a percentage of actual offshore exposure. Even the 30% that you're allowed of the 75, is a fair amount, but it's still very limiting.
Okay, but you don't actually have a constraint though. So some of the platforms do currently have constraints. They can't have 100% exposure. I agree with your point. Asset liability matching, you probably shouldn't have all your assets offshore. You have liabilities here.
As more people are taking money offshore and taking living annuities, and a lot of other commentators saying, get it all offshore, for wealthy people, fine, because whether the currency now moves from 15 to 14 or 13, a couple of £1,000 difference won't make a difference to them. But people whose main source of income is in their pension funds and they've allocated it all now to a living annuity, and then the currency fluctuates and you're getting 10,000 Rand less or 20,000 Rand less a month, that's a big concern. So, obviously back to financial planners doing the right thing and knowing their clients and making sure that you allocate correctly. But this whole debate about income from offshore and more people allocating to offshore, it's something to watch out for, I would think. Yeah.
Okay, so let's get back to offshore. Okay, so I've got a young person who wants to invest, and luckily this young person has lots of money. So how much money can I take offshore, Wayne? From a Forex perspective, from a SAR perspective, talk me through the numbers.
Well, you've got the 1 million discretionary allowance, no tax clearance needed, and then 10 million per person per year, also discretionary per year, so 11 million per person per year. Tax, it must be obviously have a tax number, etc., and apply for tax clearance on your 10 million, convert it to currency, and then send it where you wanted to go to be invested. So
we talked about liquidity constraints, I heard, but there's obviously estate planning, benefits, etc., etc. So unpack the product, the offshore endowment wrapper. Why should I put my money there?
There are tax benefits to it. You're getting beneficial tax rates within it. It's been calculated, deducted, and paid over to SARS for you, so you don't have to worry about all of that during your tax year. From a liquidity perspective, I think most of the offshore players are fairly lucky in the way they've structured the endowments, in that you have multiple contracts underlying. So liquidity, not really as big a concern as you have on a local endowment, although obviously there are slight restrictions, but not as heavy as if you had taken out a local endowment with one withdrawal only. So we find not a big concern. Interesting, when we started off, our product was tax-free many years ago, and then obviously we had a pricing arbitrage versus a list platform, which is not a wrapper, just a trading, and they were cheaper than us. But we obviously, because of the tax element, could charge more. But when the playing fields are made level, and the pricing of a wrapper versus a lisp was also, made even, I think what you're getting from a wrapper, my point is tax rates, estate duty, estate liabilities, beneficiary nominations, all of that, and you're paying the same price. I think many clients favour the wrapper still.
All right, so now we've got you've got the endowment wrapper, your life is cleaner. Just a point out from a estate duty point of view, when I leave it to my spouse, so there's no tax implications here in South Africa. I leave it to my children though. Does the full amount go to my beneficiaries and the estate has to find the tax to pay on it? How does that work?
Yeah, so I mean, obviously, if some goes to your spouse, you get the 4Q deduction from an estate duty perspective on that amount. What goes to other people, like children, your estate will pay estate duty on that amount, but the heirs or the beneficiaries will get that money. And I think that's part of the beneficiary nomination. You just change the new owners on the existing contract. The person managing the money carries on managing the money. The beneficiaries are now the new owners, so they can draw money if they need it. And it's very seamless. Then obviously you've got your executor working out the estate duty, and those assets do form part of your estate. If some are going to your wife, you get a 4Q deduction. If not, it does form part. And obviously then the estate needs to find the cash, if there is estate duty payable, to pay it at the end of the day. But obviously if I'm a beneficiary, I've inherited that, and there's no other money, well then we'll have to bring some money back to pay the estate duty, which at the end of the day is not the end of the world.
Where can I go in the world that I can still use my offshore endowment wrapper?
No. Look, I mean, you get endowments and endowments, meaning you get a South African resident-only type of a wrapper, which we mainly sell, meaning you're getting tax calculated, deducted, paid over at beneficial tax rates. So as long as you're a resident of South Africa, great deal. When you're immigrating, as Diesel said, you've got to be very careful. It becomes very specialized in every different country that you go to, how they will adopt or adapt and say what the story is. So you need to get somebody to find out for you, how will this be treated. Many of our South Africans go to the UK, not very favorable. The UK just deem a 15% CGT rate on your capital, irrespective of whether you got it or not. And if you were active on the portfolio, there's a CGT payable in South Africa as well. Hence, these are mentioning double taxation, which you don't want to pay. So generally speaking, and it's very general, depends on where you go to, but generally the wrapper will probably not be appropriate for people immigrating because of double taxation, because of some countries deeming it maybe as full income, and also being there to pay double tax. So probably get out of it. If you are in a stockbroking portfolio with anybody, then you can obviously take it with you. And just like in South Africa, there will be capital gains tax implications, and you'll be able to say, well, that was the capital gain. I'm now a tax resident wherever I'm living, and you will pay the appropriate rate. So it's probably easier unwinding it, generally speaking, a South African wrapper. Obviously, people immigrate, you get international wrappers as well. Some guys will create a trust, maybe if he can, before he goes. Then it becomes a different aspect, a different ball game, but quite technical. Before you go, find out what are the rules, where you're going, how they're going to treat it. Because sometimes, depends on where you're going, it's beneficial to structure things properly, like a trust, for example. Gets treated differently in all jurisdictions, and sometimes it could be beneficial for you to put it into trust before you leave. So yeah, and there are people giving, yes, you pay, but it's in the longer term, it's worthwhile paying now and finding out what the actual rules are before you leave and getting your structures in place.
I agree with you at the point of hedge funds that are not daily dealing, but a lot of the UK UCITS funds are daily dealing, so there isn't a liquidity issue there. Are you seeing any demand for that coming through, given that global markets currently are quite tricky?
Not at the moment. We've had no requests for people wanting to add hedge funds to our platform, which they can access. The open architecture sides come more on the custody side of the business, or the stockbroking side, where guys can buy hedge funds or whatever. DFMs is a big thing as well, where people are managing funds or share portfolios, and within their cocktail, as I call it, they might have a hedge fund or two that they put in for their clients. So that is available. But I think what Andrew's referred in the past, we had a lot of hedge fund managers in South Africa coming to us asking to put their funds on the platform. They were quite popular until you had the 2008 liquidity problem within hedge funds, and then clients wanted their money out and then found out, oh, I had to give notice by the 15th of this month, and now I'm on the 17th, so it's another whole month or two that I have to wait. And I think that put quite a dampener on it. And also, not that I'm a boffin at it, but if I look at the returns on hedge funds, I think it's been very average compared to other asset classes. So
is what you're saying that advisors are still putting their clients offshore into sort of balanced products, and then maybe a few satellites around it? That's fascinating, but you're also dealing with discretionary fund managers now and multi-managers. Are they doing a similar thing, Wayne?
Well, we see quite a high weighting to equities, actually. So if you look at, coming back to the restriction on funds, we've got hundreds of funds available, but then you look where the money's going, it's very restricted down to the usual, 20% taking massive, most of the flows. We actually looked at it this morning, and it's a high weighting to equities, actually. Obviously, the last couple of months, where uncertainty in the markets, people are maybe going for a cautious, and cash has pushed up quite high on our balance sheet, quite a bit. People uncertain probably, but generally speaking, if we break our total AUM down, it's quite highly weighted towards equities. And I think what Lisa was saying early on, people taking money offshore, generally it is their discretionary money. They kind of feel they sorted out in South Africa. So this is for growth. These are growth assets. And yeah, if I look at the fund specific, and even we broke the stock broking down as well, it's very high towards equity.
And I remember I didn't ask you the simplest question ever. So Wayne, with you, what's the minimums to put money offshore?
Well, ours is $20,000 to get into the fund side, and $75,000 to get into the custody side of business. The youngsters are all wanting to get offshore exposure, bank accounts. They're working on their phones on all the different trading platforms, etc. But eventually they will get an amount. We also find that once a person has chosen a platform, they don't easily change. So having your minimums quite high, you waiting a while, and then when he eventually gets there, he's not going to come and say, okay, now I'm coming over. So we're down to $20,000, and we've seen the tractions picking up on that. And also we see that because you're dealing with also a certain segment of the market, additions to, or top-ups as we call it, to existing investments is quite high. It's about 50% in our space. Okay. So once you get once you get somebody there, he will stay with you unless really cause hassles for him. But so that's why we're reducing the minimum to 20, get the younger people coming in, and hopefully they'll stick around for a while. Thank you very much. I think you've demystified offshore investing. I think clearly the minimums now are a lot lower than they used to be. I'm glad to see people still want to put money offshore because of the choice. Let's face it, you don't want to only buy commodity shares or banking shares in South Africa. So there's a lot more choice offshore. So thanks very much for your time.